Hi everybody, Jeff Yastine here. One of the best investing lessons I've ever received was from an old retired trader. I'm going to call him Big Bend George because that's where he retired to, down in the Big Bend area of Texas, which is right near the Mexican border. One of the points that he made to me, he would call me every few weeks. I used to work for a program on PBS Nightly Business Report, and he was a fan of the program and liked what we were saying. So every few weeks he would call and we would talk about the markets and talk about where we saw investments, just as a personal sort of thing. One of the points he kept making to me can be summarized in 5 words. Go where the growth is. In other words, focus on where the big, most obvious opportunities are. Don't bother chasing areas where there's either high valuations or a great deal of competition in a sector already, because the companies there obviously have to divide the spoils from that sort of competition a number of different ways as they compete for their slice of the market. So as he said, go where the growth is. And these days, the growth is really in emerging markets, not so much the economy of the United States. Case in point, where is the fastest growing index since the late year sell-off began in September last year? Well, it's the MSCI Emerging Markets Index. You can look at the ETF equivalent, which is EEM, that's the symbol. It's outperformed the S&P 500 by more than 5 points since September and is in positive territory, while the S&P, Dow, and NASDAQ remain in the red. But then again, to paraphrase my buddy Big Ben George, where is the growth these days? It's certainly not in the US, where the economy is expanding at 2% at best, and economists have it dwindling down to growth of roughly 1.4% by 2023. On the other hand, emerging market economies are growing like crazy. In India, the economy is growing at 7% a year. In China, it's growing 6% a year. If that's too far afield, if those seem too exotic, look at what's happening in Latin America, where the growth rate of the major economies in that region are pegged to grow at a steady 3% or better. They also have very good demographics, which helps to support economic growth. And at a GDP of 3% or better growth, that's roughly twice what we have here in the US over the next few years. So the prospects are so good in Latin America that Japan's SoftBank, which invests in a lot of technology firms and startups and that sort of thing, they recently created a new $5 billion investment fund focused on the region's rapidly developing digital and communications economy, which is something that region hasn't had much in the past before. So is it any wonder then that emerging market stocks are starting to outperform? And I think we're really at the very earliest stages of all this. We have 3 big factors now coming into play that are going to help emerging market stocks even further. At some point soon, the US and China will resolve their trade impasse. It almost doesn't matter what the agreement is. The main idea here is that the uncertainty gets removed, and that clears the way for investors to go even more deeply into emerging market positions. Likewise, Europe's lingering Brexit nightmare is also due to be resolved with a vote at the end of the month in Britain. And again, that resolves the uncertainty there. Doesn't really matter whether Brexit is good or bad. The whole idea is clearing that uncertainty off the table. And lastly, we have the Federal Reserve, which has pretty much made it clear that they're going to stay on the sidelines and keep rates where they are until they see really obvious signs of inflation. And that gives, the more time they stay on the sideline, the more time that gives emerging markets to get red hot with growth, and I believe they will. And for investors who get in now, that will swell their wallets even further. Something to keep in mind as we go forward. If you like what I'm talking about, make sure to click on the screen. Until then, I'm Jeff Yastine.